The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. American equities plummet and long-term borrowing costs hit their highest in nearly 2 decades as investors find little to like in the Fed's fifth hold in a row. But the chair, Kevin Warsh, hints that a hike could be on the way.
It's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make.
Investors digest a mixed bag of tech earnings from across the pond. Microsoft's cloud growth accelerates at its fastest pace in nearly 5 years, but Meta takes a hit as Mark Zuckerberg doubles down on AI spending. Strong EV demand boosts Renault sales in the first half as the French car maker withstands pressure from its Chinese peers. But the CEO has this warning for Europe's car makers.
I see Europe is organizing the decline of the automotive industry. So it's why it's time for a wake up.
It's a real privilege to do my job on a day like today because we have so many top CEOs and CFOs on the show, from Rolls-Royce, Shell, LSEG, Anglo-American, Intesa, you name it, they are coming. Schneider Electric coming in a few moments' time as well. Plus all the market-moving stories. Seriously, if you love news and you love business, this is the place to be for the next 3 hours, honestly. OK, I'm going to do a couple of quick Shell numbers as well. I think they're a solid beat, actually. Second quarter adjusted earnings coming in at $9.8 billion US dollars versus expectations of 8.8 billion as well. They are talking about a dividend of 0.3906 as well. The EBITDA at 20.7 billion, beating the expectations in the second quarter of 20.2 as well. The integrated gas outlook excludes any volumes from ARC Resources. They are talking about capex at 24 to 26 billion. Dollars. Right, I'm going to leave it there because we're going to speak to Wael Sawan in exactly 33 minutes' time. I say exactly because this is a very choreographed show because we have so many CEOs coming up today. Let's carry on. Schneider Electric reported record revenues in the first half amid strong demand for its products. The company also lifted its targets for the year. Great chance then to speak to Olivier Blum, who is the CEO of Schneider Electric. Olivier, I always love our conversations, so thank you very much indeed for joining Ben and myself this morning. Look, I spend a lot of time poring over numbers and I try to find some idiosyncrasies, some negative figures within any numbers, even when they're good. I'm struggling at the moment. Just talk us through the numbers. They look very good to me.
Thank you for having me, and it's great to be with you. Look, it's a very, very solid H1. We are very pleased with the performance. Of course, we have a great outlook. We have revised our guidance. As I like to say also in sport, it's half time of the game. We have 6 months to deliver. But if you look fundamentally, what are the drivers of Schneider Electric growth? For past 10 years, we've been saying it's about electrification, it's about digitalization to deliver the next level of efficiency for our customer in buildings, data center, infra, and industry. And we are at a point of time where our portfolio is coming well together and we can make the most of it and do a great job for our customer. And we are excited because it's not only our energy management business, it's also our industrial automation business, which grew 11% in Q2. So all in all, it's very solid, but more than just 26. It shows that Schneider Electric is really advancing energy tech to the next level by also bringing more intelligence to our customers. So it's a very exciting time for us.
I know you and your team work very hard on the first answer, Olivier. All CEOs do, but you got in a lot of key points there. It's not just energy management. It's not just data centers, because that is the issue, isn't it? People are looking at companies like yours that are having this enormous growth in those areas, and they're saying, is that where the opportunity and the danger is as well? Just to expand on the data center business as well. No concerns about the rate of growth?
Well, look, data center is equal for us to building industry and infra in terms of weight of ourselves. So it's great to be in data center, and we benefit definitely from the AI infrastructure boom. As you know, we have been in data center for more than 20 years to build a really unique portfolio across the life cycle. So it's not only the capex when you build, it's also the services, it's also the digital layers. We look at our customer, we look at the demand, and we see a very, very solid demand for the next 2 to 3 years. Now, to tell you what it will be in 2030, I cannot say. At the same time, as I said in my introduction, we are bringing digital, we are bringing AI in every single connected product of Schneider to deliver more intelligence to our customer. And if you would ask me as a CEO of Schneider, both on where I use AI for my product, for my customer, but also to make Schneider more efficiency, we are just at the beginning. So frankly speaking, I think we are just at the beginning on how companies, people will leverage AI to deliver more efficiency. So I think all in all, I see a pretty good equation between the build of data center for the next 3 years and the growth of consumption, at least for what I see at Schneider Electric.
Olivier, you and I have spoken about this very issue many, many times in short form and long form as well. So I do really value what you have to say on this one as well. But we've seen other CapEx cycles, and some of those have ended very, very badly. The market at the moment, I know it's a short-term beast, is very concerned about capital expenditure without seeing the revenues and the ultimate profitability. I know you're looking as an observer because you're happy to build this stuff for these clients, but do you have any concerns about this CapEx cycle creating a boom and then a bust?
Well, look, what we have observed, first of all, to be able to deliver, to build those infrastructure, we are talking about physical asset. So there is always a correction anyway every year between what is the demand and what is the execution. It does not go always as fast as it should be. You have problem of permitting. So I think it's important sometimes to bring a bit of a correction factor on the big number that you see and what is going really to happen. At that point of time, again, I think the equation is working. I think people have to be disciplined in the way they forecast. That's what we do at Schneider. We look at the demand, we apply our own correction factor, and we say, okay, this is a trajectory for the next 2 to 3 years, and we'll build capacity accordingly. Now, at the same time, we see, again, I repeat myself, that AI is impacting and bringing intelligence in every single part of our company.
Olivier, it's Ben here joining the conversation. As if companies didn't have enough to contend with this year, we now have the extreme weather that's affecting France and Spain, and of course you have a big presence, big factories there. You've had to take short-term measures. I just wonder what you feel the outlook is for companies like yours and how you deal with that, because operationally this is going to become very much a fact of life, isn't it?
I think it's already the case today. I had the chance in my life to spend more than 20 years in Asia, between China and India, in an environment where every single day there is something happening. And today what we see, which is on the acceleration of the fragmentation of the world, you take all the example you've mentioned. I think as a company, we've tried really to build a muscle that help us to navigate very, very quickly in this kind of environment. And I used to say, there is not much we can do about this external environment. Now there is a lot that Schneider Electric can do by being more agile, by being more regional, by being closer to our customer, and being very, very fast in the way we act and react to this kind of environment. So there is not much we can do about the environment, but there is a lot that we can do on ourselves, Schneider Electric, to be more agile and move faster everywhere in the world. And the world is not one anymore, as I said. We have to be Chinese in China, Indian in India, American in America, and European in Europe.
Okay. Also note from your update this morning that you're expecting the disruption from the Middle East to impact the second half of the year. You talk about the potential for pressure on global supply chains and increased inflation. How are you positioning to best withstand those potential pressures?
Look, we've seen, of course, this impact in the first part of the year. It has an impact on the cost. Of course, it has created an inflation of cost of energy, cost of material, cost of transportation, but at the same time, disruption in supply chain. I would say we've put our plan really to mitigate all those factors, to protect our P&L, but more important, to protect our customer. Now, as you rightly said, we are entering H2 with the same level of attention because we don't believe it's going to slow down immediately. And whatever happens in Middle East, let's make it clear, we will not get out of all those disruptions before probably H1, even H2 2027. So we have to live with it and make sure we are agile in this kind of environment.
Olivier, back to me, I'm afraid. Cognite and AI Dash as well. Part of the just enhancing the offering you've already got, both on AI and Internet of Things as well. What kind of size of deals are we talking about? Are we just small bolt-ons still going forward? Nothing transformational?
You know, first of all, on Cognite, I'm very excited because it's a very rare company. It's a very rare technology. And we've been talking together a lot about Schneider, a company that connects the physical world for 190 years, but want to connect the physical and the digital world. And Cognite is coming at a point of time where we need to build a very strong data foundational layer, which is AI native, on which we can bring AI and agentic capabilities for our customer to deliver the next level of intelligence. So AI is really going to position that like that at Schneider Electric. We need to amplify everything we do in the future. And coming back to the topic of M&A, you know, I've been very, very consistent. Most of the growth profile of Schneider Electric in the next cycle is clearly organic. Every time we find good technology, good company at the right price that help us to accelerate the execution of our strategy, we love to do it. And Cognite is a perfect example. Like Motivair, you know, 2 years ago, was a great way for Schneider Electric to enter big time in liquid cooling for data center.
I think I've got time for one more. Your free cash flow is up 244%, and then you've got this little footnote, which is, for my eyes, I can barely see, but it's 140% when you're considering a one-time impact of a legal case. With that kind of free cash flow and very strong earnings, isn't it time to up the dividend a bit more aggressively? You're only giving people 1.6%.
You know, on dividend, I think we have been extremely consistent and progressive for the past 16 years. Actually, we have delivered a strong dividend, progressive dividend to our shareholders. We've been also very, very disciplined on credit rating. We have also committed in our next program to increase our share buyback. So I think at the end of the day, when you put everything all in all from a capital allocation standpoint, we are extremely disciplined and with really always a very strong objective to return a lot to our shareholders.
I know it wasn't our turn to speak to you this time around and you squeezed us in, so I really appreciate it. Have a great summer and I'll speak to you again in the autumn. Thank you very much indeed for joining Ben and myself. Olivier Blum, CEO of Schneider Electric. Ben.
The Federal Reserve has held rates in a 9-3 vote, the fifth hold in a row. Dallas Fed President Laurie Logan, Minneapolis Fed Chief Neil Kashkari and Cleveland's Beth Hammock dissented, seeking a quarter-point rise amid resurgent price pressures. Chairman Kevin Warsh reiterated the central bank's commitment to tackling inflation, arguing that leaving rates unchanged did not show signs of inertia. Despite the repeated commitments, Warsh failed to specify how he would look to tackle inflation and stopped short once again of saying he would support a hike. Well, that seemed to weigh on the markets. The Dow down decisively on the day, closing the session 2.2% lower. The S&P 500 also closing sharply lower, and the Nasdaq extending the losses from the previous days, closing off by 1.25%. And we can see the effect that all of that had on treasuries. Those jumped on those comments and the fears that there could be inflationary pressures filtering through in the absence of a hike. There is now a bet that the Fed could raise rates at its next meeting in September. You can see the moves there on US Treasuries. But let's focus specifically on the 30-year Treasury, because the yield on that hit its highest level since 2007 following the Fed's decision. This comes as bond traders increase their bets on that rate hike potential at the central bank's September meeting. Chairman Kevin Warsh said markets have done quite a bit in his 42 days in charge and would have more decisions to make ahead of the Fed's next meeting.
I think it's a mischaracterization to say that markets haven't reacted because we didn't move today. Markets are reacting in real time. In the period ahead, we've got important decisions to make about the policy rate. Markets in the intervening period, I think, have quite a bit of decisions to make.
Oh, there's so much to say about that. We'll do that later on. Coming up on the show, big tech threads the capex needle as companies race to meet AI demand. We'll take a look at the winners and losers. There were big ones on both sides from last night's earnings report stateside. Plus, here in Europe, earnings out of Renault and Airbus overnight will bring you the numbers and our C-suite interviews. And we have another busy day of earnings. This hour, we're going to be hearing from Helen McCabe, who is the CFO of Rolls-Royce, and Wael Sawan, who is the CEO of Shell. We'll put in Duncan Wamblad and David Schwimmer over the next hour or so as well. A huge number of CEOs joining us here on Squawk Box. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Welcome back. Rolls-Royce has raised its full-year guidance after posting £2.4 billion in operating profit in the first half. Revenue came in at £11.4 billion, well ahead of expectations. I'm delighted to say Helen McCabe, the CFO of Rolls-Royce, joins us live in the studio this morning. Helen, very good to have you with us. So, better than expected. What do you put that down to?
Yes, as you say, strong set of results. Operating profit and cash, double-digit growth across all three of our businesses. That operating profit, 2.5 billion, it's actually more than 45% higher than last year. Cash, 2 billion, that's about 25% higher than last year. And that strong result has enabled us to increase our guidance for the year, but also reward our shareholders. We're announcing an interim dividend today, and that, along with our buyback, means we'll be returning about £3.5 billion to our shareholders this year. So what's that down to? We've got a very clear transformation programme that we've been executing for the last 3 years. As you can see from the results, that's absolutely delivering, and there's more to come.
I noticed that one of the things that you're focusing on is the Airbus A350 stretch. Just tell me a little bit more about that.
Yeah, so Airbus at the Farnborough Air Show last week made some comments that they were looking at a stretch. They haven't made any decision. That's obviously for Airbus to decide. But what I would say is Airbus are a very important partner to us. We're exclusive with them on a couple of our engines. They're called A350-900 and 1000. So we look forward to continuing to work with Airbus as they develop their thoughts and make a decision on that.
How much, lovely to see you, by the way. How much are these key decisions dependent on, I mean, there will be, obviously progress at Airbus, but the question is whether it's Rolls-Royce and whether it's built in the United Kingdom as well. How much are these key decisions, I'm fascinated to know, dependent on government support?
So, well, the government is a very important partner with us. The UK market is incredibly important to Rolls-Royce. I mean, what we do supports more than 73,000 jobs in the UK. We bring 12 billion to the economy, 8 billion to the export market. And the programmes that we are involved in are decades of investment. For example, the last few weeks, the government announced its defence investment plan, and in that they pledged just under £9 billion to GCAP, the Global Autonomous Aircraft Programme, and £5 billion for autonomous investment, where we have leading positions. So our partnership with the government is important.
Yeah, but you know as well as I do, and you went there, so I'm going to follow you in. On the defence review, it was a pig's ear, really, and it was perhaps final coup de grace, dare I say it, with the Chancellor now, former Defence Secretary, for the former administration. Do you get the impression that this blend of government, which is ostensibly the same government, but just a different blend of it under Andy Burnham. Do you think they understand the priorities for backing defence and backing British business? Because quite frankly, there were big questions about the previous regime.
Yeah. I mean, so we've had very positive initial conversations with the new government, and we absolutely support their focus on growth, defence and advancing industrial manufacturing. And we look forward to supporting them in that and playing our role. The UK is one of our key home countries, so we look forward to working with them in that regard. And the Defence Investment Plan that was announced just in the last few weeks does provide certainty around where industry can plan and make progress over the next few years. For the first time, we do have a view of what funding plans are out to 2030 and beyond for some of the key programmes.
But he won't commit to 2030 3%, will he? That's the problem.
Well, but we do have commitment for some of those key programmes, as I said, GCAP, Hawkish. For the first time, we see quite specific commitments around autonomous 5 billion.
Yeah, Helen, I don't know if you were in Ankara because of that big defence investment forum on the first day of NATO. I was there and it was quite extraordinary as well. But how important is NATO, I don't know, we're on 2.0 or 3.0 now for Rolls-Royce? Because Europe is finally realising it has to defend itself.
Absolutely. So, I mean, defence is an important part of our business. If we look at our 3 businesses, 2 of them are represented in that area. Obviously our defence business, where we provide platforms that last 60, 70, 80 years. If you think of the B-52 in America, we're re-engineering that. It's been flying for 70 plus years.
They're re-engineering the B-52?
Yes.
Isn't that extraordinary?
But it's been flying for like 70 plus years. You know, so these are
was the
big
B-52
generational...
the Dr. Strangelove bomber? I think it was, wasn't it? I'm going to have to check on that one.
But you know, so we've got a very, very established defence business, and that tends to be multi-generational. But then in our power systems business, we have what's called governmental, and that's more land and naval, and that's much shorter cycle. And we've got very established positions there. So we have a very strong position in defence.
I just wonder with the situation with energy prices, you know, it's a double-edged sword for a company like yours. It's an energy-intensive business. Of course, higher energy prices are going to put operating costs up. On the other hand, how much of an opportunity do you see there on the nuclear, the energy side of Rolls-Royce, and the seemingly insatiable demand at the moment for energy, especially when it comes to the data centre build-outs?
Yeah. So as you say, it's a very exciting area, both on 2 fronts, in relation to how we serve our customers and what it does in relation to energy security. In our power systems business, we have a very established data centre business. Order intake for that business grew more than 50% in the half year, 50%. So, and that's where we provide backup power for data centres. We're now also starting to provide prime power because the demand is so much. Some data centres can't get connected to the grid, so they have to have prime power use for that. And then you go to the nuclear side, and we've got a leading position in what's called SMRs, small modular nuclear reactors.
Do they work, Helen?
So they're in the process of being constructed. We have been building these reactors. They're in the nuclear submarines for 60 years, so we are very experienced.
Are SMRs the game changer everyone thinks they're going to be?
Yes.
Given when we see the, dare I say it, the horrendous cost overruns from Flamanville to Hinkley Point, I mean, it's just crazy.
But it's a very different concept.
Yeah.
So they're about 470, yes, so they're about 470 megawatts, so they're smaller than your big reactors. 80% of them are modular built. That de-risks significantly if you can think about what's built in the factory and then transported onto the site, about the size of 2 football pitches.
We haven't asked you an AI question, and look, it's great that you're building this state-of-the-art facility as well, which it sounds really, really exciting as well, and is a great endorsement of what happens next in places from Belfast to Bristol as well. But in terms of AI and workforce as well, there are young men and women watching the show who are just tearing their hair out with applications at the moment. Is Rolls-Royce net hiring engineers still, or is it a lot of it just being done by AI now?
Oh no, we're still net hiring engineers. Yeah, there's a huge demand. If you think about what's happening across the business and the growth opportunities that we have, it's a very exciting place to be. And actually, we run some of the best trainee for graduate and apprentice programs that you could actually find.
Amazing.
And a lot of them are brought through there.
I'm such a huge fan of what you're doing on the
Nuclear
apprentice
Skill
front.
Academy.
Fantastic.
Yeah.
Helen, final question. I'm just going to pick up on one thing. Great you're doing the interim divvy, but come on, it's 0.69 of 1% your divvy yield at the moment. There's a lot of room for wiggle there, isn't there? I know you hold the purse strings.
Just under £3.5 billion we're returning to shareholders this year. That dividend's in addition to a share buyback that we have, and that share buyback is between £7 and £9 billion.
And the buybacks give you that latitude, whereas the divvy locks you in. I know that.
Very competitive.
Helen, thank you for coming in. We always love talking to you, so thank you so much, Steve, for coming in. Helen McCabe, who is the CFO of Rolls-Royce. Airbus earnings came in sharply higher in the second quarter, with adjusted EBIT jumping 54% on the year to €2.4 billion. The aircraft maker posted a net profit of €1.66 billion, up 126% in what was a record quarter for plane deliveries. Carolyn spoke to the CFO about whether the company could soon see profits from its own defence production.
That is true. So as I said, over 80% uplift in order intake, but revenues are only up 9%. So that shows exactly what you said. It's taking some time. The good news, I would say, is the production systems that we have, be it for the Eurofighter or for the A400M, are actually sized for much bigger quantities in terms of production. So we can relatively easily increase production in the coming years without having to make heavy investments in our defense division. And so therefore, my view is that opportunity is going to come through in the coming years without having to make heavy CapEx investments in that division.
When it comes to defense and space, everyone in Europe is talking about close collaboration. Everyone is talking about a unified European response here. But that didn't really come to fruition when it comes to the Franco-German fighter jet project, FCAS. There are a lot of reasons as to what actually went wrong, but is there a sense that this project could come back in a different form, and what would that look like?
Well, what I would say is indeed the project was in a deadlock for, I would say, various reasons. And so therefore, we do welcome that finally a decision was taken that kind of clears the way and opens the path for the way forward. What I would say from our side, we're fully committed to European cooperation when it comes to a future fighter jet. We do think that Europe needs a sixth generation aircraft. And so therefore, I think now is the time to discuss with our industrial partners, but also, of course, with the MODs, what is a good setup. And in that setup, we want to play a leading role. But clearly, we're looking for partnerships because we think that is the way that Europe should move forward.